Take $50,000. With it, you have two choices. One gets you a deed and something that impresses people at dinner parties. The other gets you a brokerage account number and a confirmation email nobody will ask about for years. 20 years from now, both choices could leave you in roughly the same financial position. The quality of those 20 years, though, turns out to be completely different. And whether you come out ahead depends almost entirely on which costs you are actually willing to count. Here's the full comparison, run honestly, with realistic numbers on both sides. Cole puts $50,000 down on a $250,000 rental property, a 3-bedroom house in a solid neighborhood. He takes out a 30-year mortgage at 7%, and his principal and interest payment works out to about $1,330 a month. He finds a tenant who agrees to pay $1,800 a month in rent. On paper, that is $470 a month in gross profit before he has spent a single dollar on anything else. Ryan takes the same $50,000 and drops it into a total stock market index fund, setting up automatic contributions of $300 a month going forward. Here's where that $300 actually comes from, because most versions of this comparison never explain it. Ryan is renting an apartment at about $1,030 a month, which is $300 less per month than Cole is paying toward his mortgage alone. Both men are covering their housing costs. They are just doing it differently. On day one, Cole has a house with an active tenant and something to point to from the car window on the way to work. Ryan has a brokerage account and absolutely nothing to brag about. That gap in how each path feels is going to be one of the most important threads in this story. If this kind of analysis is useful to you, subscribing keeps more of it in your feed. For the first couple of years, Cole is living the version of this story that gets shared at backyard cookouts. Rent checks arrive on the first of the month. He drives past the property on his way to work and feels the quiet satisfaction of ownership. He is claiming mortgage interest and depreciation on his taxes, which shaves a meaningful amount off his annual tax bill. Every mortgage payment builds a little more equity. The neighborhood is appreciating. Everything about this investment feels solid, tangible, and correct. Ryan logs into his brokerage account once a quarter. Year one, his $50,000 has grown to roughly $55,000. Year two, somewhere around $61,000. It does not feel like anything dramatic is happening. There is no key in his pocket, no tenant texting him, no asset he can gesture toward. Just a number on a screen that increases slightly faster than he expected. His coworkers do not ask about it. Nobody is impressed. Now, look at Cole's actual numbers through year three. He has collected roughly $64,800 in rent. His mortgage payments during that period total about $47,880. That leaves around $17,000 in gross cash flow on paper. But property taxes run roughly $3,000 a year. Insurance adds another $1,500. During that stretch, he replaced a failing water heater for $1,200, had a roof section repaired after a leak for about $2,800, and absorbed 1 month of vacancy between tenants that cost him $1,800 in lost rent plus $600 more to clean the unit and find a new occupant. Cole is managing the property himself to avoid the 8 to 10% management fee, which means he is the one taking the Tuesday afternoon calls and coordinating repair contractors on his lunch break. After all real costs, his actual net cash flow over 3 years lands somewhere around $4,000 to $6,000 total, not the number that looked so good on the original napkin. Ryan, meanwhile, has deposited $50,000 up front, plus $10,800 in contributions across those 36 months. At roughly 10% average annual returns, his portfolio is sitting at approximately $76,000. He spent no weekends managing anything. 0 phone calls, 0 repair invoices. The one real advantage Cole still holds is leverage. His $250,000 property has appreciated at 3 to 4% annually and is now worth somewhere between $270,000 and $280,000. His equity, the $80,000. His equity, the spread between what the home is worth and what he still owes on the mortgage, has grown to roughly $55,000 to $65,000. That is real wealth, and a meaningful portion of it was built using the bank's money rather than his own. The rent check is the number that gets written on whiteboards at real estate meetups, and it is the figure that ends up on every rental property thumbnail. What almost never gets discussed in the same breath is everything that gets subtracted before that number becomes actual money in Cole's pocket. Vacancy alone is the first invisible cost. The general professional estimate is roughly 1 month of vacancy per year on a typical single-family rental. That is not a disaster by itself, but it is a full mortgage payment with zero rental income to cover it. And when a tenant moves out, the vacancy itself is just the beginning. Cleaning costs, listing fees, tenant screening, and showing appointments all pile on top. Maintenance is the second cost that gets systematically underestimated at the start. The standard professional benchmark is to budget 1 to 2% of the property's value per year for ongoing upkeep. On a $250,000 home, that is $2,500 to $5,000 annually. Some years it is a $200 faucet repair. Other years it is a $7,000 HVAC replacement in August with the tenant calling twice a day. Then there are capital expenditures. Roofs at 20 to 25 years, furnaces at 15 to 20, water heaters at 10 to 12. These are not surprises. They are predictable future expenses, arriving in chunks of $5,000 to $15,000. And a landlord who is not setting money aside each month in anticipation is not running an investment. They are running on borrowed time. If Cole hires a property manager, that typically costs 8 to 10% of monthly rent, or about $150 to $180 a month in this scenario. If he manages it himself, he avoids that fee, but is now working a part-time job he is not being compensated for. Either way, the cost is real. And then there is the risk almost nobody mentions in the original pitch, the genuinely problematic tenant. One who understands the eviction timeline and decides to stop paying can cost 3 to 6 months of lost income, plus legal fees before the property is recovered. The most pointed criticism of comparisons like this one is the contribution question, and it deserves a direct answer. If Ryan gets to contribute $300 a month, while Cole adds nothing beyond the down payment, the comparison feels uneven. That instinct is worth taking seriously. The honest accounting, though, is this. After vacancy reserves, maintenance costs, property taxes, insurance, and the capital expenditure fund, a responsible landlord should be building every month. Cole's paper surplus of $470 routinely shrinks to near zero or goes negative. Ryan's $300 monthly contribution does not come from a comparison trick. It comes from his genuinely lower monthly housing cost, the real difference between his apartment rent and what Cole pays toward his mortgage each month. By year 5, Cole is on his third tenant. He replaced the roof for $8,500, dealt with a plumbing emergency that cost $1,400, and absorbed another month of vacancy between lease transitions. He has raised rent to $1,950, which improves the monthly picture, but property taxes and insurance have both crept upward in parallel. His actual cash-on-cash return, the real money he pockets relative to his original invested capital, is hovering somewhere between 3 and 5% after all genuine costs are accounted for. That is not a ruinous result. It is simply a very different story from the 15 to 20% figure that tends to circulate at real estate networking events. Ryan has done nothing except not sell. His portfolio, sustained by consistent monthly contributions and compounding at roughly 10% annually, has grown from $50,000 to somewhere around $110,000 by year 7, including all contributions. The acceleration is subtle in the early years, and then it suddenly is not. The returns generated on previous returns are now producing more new wealth each year than his direct monthly deposits are. The compounding curve has started to bend in a way that was not visible in years 1 through 4. The underlying dynamic at this stage is worth naming precisely. Cole's wealth is growing, but it is growing in fits and starts, shaped by repair cycles, and the fundamental illiquidity of a single physical asset in a single zip code. His equity is genuine, but accessing it means either selling the property or refinancing it, and neither process is frictionless or fast. Ryan's wealth is growing on a clean curve that accelerates with time and requires no action on his part to sustain. By year 10, Cole's property has appreciated to somewhere between $335,000 and $350,000. His remaining mortgage balance sits around $166,000, putting his equity at approximately $170,000 to $184,000. Against that, he has spent somewhere between $20,000 and $35,000 beyond the original down payment in cumulative out-of-pocket costs. Ryan's portfolio has reached approximately $165,000 to $180,000, built from $50,000 upfront and $36,000 in contributions. At year 10, these two men are surprisingly close in total wealth, with Cole holding a modest lead from leverage. That year 10 closeness deserves more examination because the summary number conceals a structural difference that matters enormously. Cole's equity is concentrated in a single physical asset in one specific neighborhood. If that neighborhood stagnates, if a major employer leaves town, if the surrounding area changes character, Cole has no diversification and no exit that does not cost him 5 to 9% in transaction expenses. He also carried over $200,000 in mortgage debt for a decade, operated what is effectively a small landlording business on the side, and spent a meaningful number of hours every year on tasks that generated no direct financial compensation. Ryan's portfolio is spread across thousands of companies in dozens of industries. His worst single-year outcome is a market correction he rides out by not selling. He has taken on no debt and added no operational complexity to his life. The story fully separates in the second decade. By year 20, Cole's property has appreciated to somewhere between $450,000 and $500,000. Depending on whether he made any accelerated payments, the mortgage is either retired or within a few years of being paid off. His equity sits in the $400,000 to $500,000 range. Over 20 years of rent collection, subtracting maintenance, repairs, vacancy, taxes, insurance, and at least one significant renovation, his cumulative net cash flow above all costs lands somewhere between $40,000 and $80,000. In a strong appreciating market, it could be higher, but in a flat or softening market, it could be considerably less. Ryan's portfolio at 10% average annual returns, sustained by $300 monthly contributions, has grown to approximately $420,000 to $460,000. He contributed a total of $122,000 across 20 years. The remaining $300,000 or more is pure compounding growth. He carried no debt. He managed nothing. At the 20-year mark, both men are sitting in a similar wealth range, but the paths that brought them there are completely different in terms of risk, stress, and time. The single most underappreciated variable in the entire 20-year story is what happens when Ryan modestly increases his ambition. If he raises his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $580,000. In the stock market, increasing your contribution has a compounding multiplied effect that amplifies the entire future trajectory. In real estate, scaling up generally means acquiring another property, taking on another mortgage, and absorbing another full cycle of capital expenditures and tenant management. If this analysis stopped here, it would be guilty of exactly the bias the most perceptive viewers identify in every version of this comparison. Acknowledging only the friction of real estate while treating the stock market as a smooth, uninterrupted climb would be intellectually dishonest, and the real risks of index fund investing deserve the same direct treatment. Volatility is not an abstraction. In 2008, the broad market declined roughly 37%. In the spring of 2020, it fell 34% in under 5 weeks. If Ryan had built his portfolio to $150,000 and then watched it drop to $95,000 in a matter of months, that is not a number on a screen. That is a genuine psychological crisis, and the data on how ordinary investors respond to that crisis is not encouraging. Study after study confirms that retail investors tend to sell during the worst of a decline and return to the market after much of the recovery has already happened, locking in losses at precisely the wrong moment. The 10% average annual return figure that makes the math work for Ryan assumes he never does that. For many people, that assumption is harder to honor than it sounds when a portfolio statement arrives mid-crash. There is also no cash flow in the traditional sense. Cole receives a rent check every month, which is a concrete, spendable thing. Ryan's index fund pays a dividend yield of roughly 1.5% to 2% on a total market fund. On a portfolio of $150,000 that works out to somewhere around $200 a month before taxes, that is not replacing anyone's income, and it is a meaningful lifestyle difference for someone in or near retirement who is counting on their investment to generate spending money. The leverage gap is real as well, and it consistently gets glossed over by stock market advocates. Ryan used $50,000 to control $50,000 in assets. Cole used $50,000 to control a $250,000 property. That 5-to-1 leverage ratio is the primary reason real estate appears in more first-generation wealth stories than index funds do, and it is the honest structural advantage that the ownership side of this debate rightly defends. When property values rise, leverage amplifies every dollar of appreciation. The mechanism that makes the math uncomfortable for Cole during flat or negative years is the same mechanism that accelerates his equity growth during strong appreciation periods. Finally, depreciation is a genuine tax advantage that stock investors simply do not have access to outside of retirement accounts. A landlord can deduct the theoretical annual decline in a building's value from their taxable income, even while the property itself appreciates in market value. On a $250,000 property, that depreciation deduction can meaningfully offset rental income and reduce the annual tax burden. Cole's tax situation, handled by a competent accountant, looks considerably better on paper than the raw cash flow numbers suggest. Real estate wins in specific, identifiable situations, and the conditions that define those situations are worth naming precisely rather than leaving them as vague encouragement to do your research. The first condition is the rent-to-price ratio. When monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in the landlord's favor from the beginning. On a $250,000 property, that means monthly rent of at least $2,000 to $2,500. Cole's $1,800 rent in our scenario sits below that threshold, which is part of why his numbers stay compressed throughout the comparison. A landlord who sources properties where the ratio is genuinely favorable starts the entire 20-year journey from a structurally better position, and the cumulative difference in real cash flow is substantial. The second condition is operational discipline. The landlords who consistently outperform in this asset class are the ones who screen tenants with the rigor of a credit officer, budget monthly for capital expenditures before they occur, build relationships with reliable contractors rather than scrambling when something breaks, and treat the rental as a business with its own accounting rather than a side arrangement attached to their personal finances. The difference between a rental property returning 4% and one returning 11% often has less to do with the market and more to do with how systematically the owner operates it. House hacking deserves its own mention because it changes the fundamental math in a way that pure rental ownership cannot match. An investor who purchases a duplex or small multi-unit property, lives in one unit, and rents the others can reduce their own housing costs to near zero while building equity with a favorable owner-occupant mortgage rate. The stock market has no equivalent to that structural advantage. Ryan pays rent every month regardless of how well his portfolio performs. An owner-occupant in a well-chosen small multi-unit property can effectively eliminate that expense while the asset appreciates. The 1031 exchange is the other mechanism that sophisticated real estate investors use to build wealth in ways that index fund investors cannot easily replicate outside of tax-sheltered retirement accounts. When Cole eventually sells his property, a properly executed 1031 exchange allows him to roll the proceeds directly into a larger replacement property and defer the capital gains tax entirely. Done repeatedly across a career, this creates a compounding effect on the real estate side that mirrors what automatic reinvestment does for Ryan, except that Cole is also benefiting from leverage and depreciation deductions along the way. The full picture of real estate tax strategy is considerably more favorable than the cash flow numbers alone suggest, and any comparison that ignores it is working with an incomplete set of inputs. The question every thoughtful viewer eventually arrives at is the one the original debate refuses to answer directly. What actually happens when you do both at the same time? The math here is worth laying out clearly, because it changes the framing of the entire comparison. Consider a version of Cole who is disciplined enough to direct even a portion of his monthly rental surplus into an index fund position each year. In years where his cash flow is genuinely positive after all real costs, he is compounding in two directions simultaneously. His property is appreciating and building equity through mortgage paydown, while his growing portfolio compounds through market returns. The combined trajectory over 20 years does not simply add both outcomes together. It creates a wealth-building structure that is more resilient than either path alone, because the two assets respond differently to economic stress. When property values stagnate, the stock portfolio continues its curve. When markets correct sharply, the property holds its value, and the rental income keeps arriving. The more revealing insight is not which asset wins a 20-year head-to-head comparison, but how differently the two paths behave when something unexpected happens. Cole's wealth is largely illiquid. His net worth is real, but accessing it requires either a sale that takes months and costs several % in transaction fees, or a refinancing process requiring lender approval, documentation, and time. Ryan can liquidate any portion of his portfolio within a single business day and have the cash available within 2. That liquidity asymmetry matters very little during decades of steady growth and becomes the entire story during a genuine financial emergency or a once-in-a-decade investment opportunity that requires fast capital. The real trap in this entire debate is not choosing real estate over stocks, or stocks over real estate. The real trap is making a decision of this magnitude based on a single impressive-sounding number, a podcast clip from someone who got fortunate in one market cycle, or a conversation with someone who bought in a neighborhood that happened to appreciate spectacularly. Cole's story is not a cautionary tale about real estate. Ryan's story is not a guarantee about index funds. They are two versions of what happens when a specific set of inputs produces a specific set of outputs across a specific window of time. Change the rent-to-price ratio, the market conditions, the interest rate environment, the tenant quality, or the contribution discipline, and the final numbers shift substantially in either direction. So the next time someone insists that real estate always wins, or that index funds make landlords irrelevant, ask the same question regardless of which side they are defending. Did you actually include everything? The cost in dollars, the cost in hours, the cost in concentration risk, the cost in liquidity, and the cost of the path not taken. Because the answer that includes everything is the only answer worth building a 20-year decision around.